What is an intra-commodity spread in commodity trading? Imagine you're watching the prices of a single commodity like crude oil or corn, but instead of focusing on the overall price, you're looking at how different delivery months compare. That's what an intra-commodity spread is all about. It involves buying a futures contract for one delivery month and selling another futures contract of the same commodity but with a different delivery date. For example, you might buy a crude oil futures contract that delivers in December and sell a crude oil futures contract that delivers in March. You're not betting on the overall price of oil going up or down directly. Instead, you're betting on how the price difference between these two months will change over time. This is called a calendar or time spread because it involves contracts that differ only by the delivery date. These spreads are popular because they help reduce risk. Since both contracts are for the same commodity, their prices tend to move together. So, if the overall market moves slightly, the difference between the two contracts might stay stable. This means you're mainly focused on changes in supply and demand that affect different times of the year, like seasonal demand or storage costs. Intra-commodity spreads are useful for traders who want to speculate on or hedge against changes in the shape of the futures curve. For example, a farmer might use this strategy to lock in a favorable price difference between planting and harvest seasons. Or a trader might bet that the price gap between 2 months will widen or narrow based on expected supply disruptions or seasonal patterns. These spreads usually requiring less margin money than outright futures positions because the risk is lower. For instance, buying 1 month of corn futures and selling another month might only need a fraction of the margin needed for a full futures contract. This makes intra-commodity spreads a flexible tool for managing risk and capturing profits from shifts in supply, demand, or storage costs over time. Overall, an intra-commodity spread is a way to focus on the relative price movements within one commodity market over different periods. It allows traders and investors to profit from changes in the market's shape without taking on the full risk of outright price movements. This strategy is especially helpful when seasonal factors, inventory levels, or storage costs are expected to influence prices in the future.